Welcome back to a Real Estate Mindset. Happy Friday. Welcome to another morning live. Wanted to let you guys know, where'd he go? I have Charles with us. Charles is going to help me do the presentation today. Charles is part of our Discord community. I wanted to bring him on here to talk to you guys just to kind of test him, see what he's been learning. We don't always share the same insights. Hopefully he'll be right back, but definitely happy to have members of our community join us for these morning lives. I want to remind you guys, I never went to school to learn how to be, on camera. I never went to school to learn how to do filming. Everything has been YouTube and community based. So I love growing together with you. Charles, how are you, brother? You good to go?
Yeah, I'm good to go. I had a little technical difficulty there, as expected.
All right, man. Awesome. Is that, you going to play that piano later in the background?
Yeah, I wish. This is not my house in the background. This is a very nice virtual background. I'm actually I'm in like a back office of one of my restaurants. So it looks like total trash. I feel like Harry Potter right now. So,
do you really? Well, we're going to jump right into the report, guys. I'm going to get Charles' perspective. Feel free to ask him questions. Let me give a quick, shout out to everyone real quick. There's my man, Volvo. Volvo, I've been doing this for 2 years, 1 day now. I started in 2022, the end of the first quarter of 2022. Volvo has always been here, man. I really appreciate you, Volvo. Everyone, Dean, everyone, Ray. There's my man Trey, Nikki. Don't move, of course. Hopefully we'll be meeting up here when we go do our next road trip. Good morning, Vegas. Good morning. Definitely appreciate. There's Kayleen. There's Cindy. There's my man Jeff. Hope all is well, my man. So let's get started today, you guys. Basically, what has happened is the rates are exploding. The 10 years absolutely exploding. Now I'm going to show the viewers the difference in prices because we've been looking at, instead of talking about mortgage interest rates, we've been talking about pricing. So I'll get to that here in a minute. But let me show the viewers real quick kind of what is going on and what happened. So basically, guys, what happened today, March jobs reports came in hot. There's 303 new jobs. Unemployment also dropped to 3.8%. Thank God. One of the things that concerned me when I did the interview with Danielle is she was thinking that if this actually, if unemployment went to 4%, that they would start the rate cutting campaign. So again, thank God the job numbers came in hot for a couple of reasons. One, I don't believe it. There's government jobs. The data is manipulated a bit, but we don't want them to lower interest rates. We want interest rates to be elevated, especially during spring home buying season, which is exactly what's happening right now. So we'll look at data here that's showing demand is going down and things of that nature. So in other words, I'm happy that the 10 years going up. I'm glad, where we're at right now. If the unemployment went too high, man, too soon, rate cuts, demand coming back in, more inflation. So anyways, now before I begin, you guys, I'm going to do our first timestamp right here. I'm going to pull up some pricing for you guys because I want to remind everyone kind of, and I'm going to do it like this. Okay. So at least you guys will still be able to see Charles. So this is the rate sheet. So remember, we're looking at rate sheets, guys. That's really what I'm trying to explain to you and show you. And I want to show you guys basically a week over week rate sheet. And what I want to do is I want to look at this right here. I want to look at a 6.375. Okay. So when I first showed you guys this, the cost for a 6.375, you see this here, was $713. So again, before I go into the mortgage rate section, I want you guys to remember it's about pricing, okay? It's pricing that we look at. That is what's changing every single day. So in other words, okay, remember 6.375 cost $713. Okay, so $713. Now what I want to show you is the interest rates from yesterday, or I'm sorry, the rate sheet from yesterday, so you guys can see the effect that that 10-year is actually having real time as far as the pricing of interest rates. So here's what happened now that interest rates have shot up a little bit. Let me show you guys. Okay, so let's go back to here and look at the same interest rate. Okay, so look at the 6.375 right here. Okay, so remember what changes every single day. Okay, you guys know, right? So what changes every single day is the pricing. See that? So what happened here, and you guys are hopefully following along with me, is in the time that I showed you the rates to right now, the 6.375 went from a cost of $700 to now a cost of $2,100 with the par interest rate now being 6.5, because you see that's the first interest rate that doesn't cost money. In fact, a 6.5 right now gives you a rebate. So again, I just wanted to show you guys, remember, if you are shopping interest rates, it's really not about the interest rate. It's more about the price. So let's jump right in, and I'll get your opinion here in a second, Charles. Let's go into the 10-year right now. Okay. So here's the 10-year right now, you guys. We just went under 4.4. We're sitting at 4.375. Now, obviously, the job markets, we're in the market that the inflation is here to stay higher for longer, right? This is exactly what we wanted, believe it or not, in front of spring home buying season, just depending on where you're at on the side of the coin. But we are elevated, you guys. We're at 50 basis points. This was actually much higher. We got to about 4. I know we went to 4.4. So we got into 4.4. I think a couple times this morning, maybe just one time. Got close right here, and then it's dropped down. Either way, what this is going to do is it's going to raise interest rates. So here's the interest rates right here. Let me do this instead. I'm going to do it like this, okay? So here's interest rates today. 30-year here is 6.99. We'll start doing our analysis based on the 6.99%. A couple things I want to point out here, guys, just put things in perspective. There's pros and cons to really almost everything. Remember that the 30-year and the 30-year FHA and VA are similar interest rates. VA often has the lowest interest rate, almost the lowest interest rate. FHA is just basically the same, slightly lower. But I really want to point out the difference between FHA and conventional. I'm not saying you should jump on the bandwagon of FHA. I wanted to point out that generally FHA is going to be about a half a point lower, as you can see here, versus conventional. And also what I want to point out is generally what you'll find is if you're only doing the minimum down payment, I'm not saying you should, but what I'm saying is if you're only doing the minimum down payment, FHA a lot of times is cheaper. Okay. Just going to say that. A lot of times, my point is do your comparison. Watch out for the upfront mortgage insurance premium as well. Now, I want to show you guys this, and I'm going to get to you here in a minute. Charles, hang on with me. Here's mortgage purchase applications. This is the demand. So demand updated. And what I wanted to point out, guys, again, interest rates are higher going into spring than they were last year. Demand is also lower right now than it was last year. These are all things that we want going into spring. But look at this, guys, week over week change down about a quarter or 0.25. But year over year is really what I'm focusing on. That's when we kind of compare where we're at right now compared to last year. Mortgage purchase applications are down 15.63% from last year. And last year was a horrible year for the real estate market. So many people like the housing market's resilient. No, it's not. Sales and transactions have been crashing for what, a year and a half? What's happening right now is the low inventory exceeding the low demand. So hopefully this year, with the high interest rates and quantitative tightening, it will work this year as far as stopping that demand. And the demand is a lot, in my opinion, you guys, is obviously fear of missing out, things of that nature. But regardless, the industry is suffering. But let me show you what happened to the market. So now that the job numbers are out, let me refresh this real quick. And I'm only looking at December now because obviously, guys, they're always wrong. There's always going to say they're going to lower rates. They're always going to be optimistic. But here's the end of December. So this is the end of the year market reading as far as trajectory of interest rates. So they are pricing in again. This was 2% this morning. It has gone down to 1.8%. No rate cuts this year. And I'm going to say, again, if we have turmoil, I suspect we do have turmoil. I think that Jerome is saying, hey, we're going to do 3 rate cuts this year because there's some type of crisis, probably in commercial real estate, happening behind the scenes. And so he's warning us, hey, we don't know when it's going to happen, but we will have to cut rates this year, 75 basis points. But if that turmoil doesn't happen, Charles, I don't see a reason why they would want to stimulate the economy when we already have runaway inflation, because that would add to the inflation. And that's a lot of what the bulls are saying. And Jeff, I think he's online. Jeff, Johnny understands this, but that's their concern, right? They're not going to let it crash. They're not going to let it crash. The interesting thing is the only other time in the last, 50 years that we've had a housing market crash was during a presidential election. Isn't that funny? Is that funny, Charles? Really, the one time in my life that we had a housing market crash was actually during the election. I wonder if history will repeat itself. But the interesting thing is 1 rate cut, market saying 11.6%, 2 rate cuts, 29%, 3 rate cuts, 34%. So that's where we're at as far as that. Let me show you guys the amount of interest you pay. I'm almost done, Charles. As far as amortization schedules, remember, you guys, a mortgage stands for a death contract. So please, for the love of God, knock that sucker out. There's a lot of ways to attack that amortization schedule and save yourself $100,000. So right now, you guys, as far as where you're at with a 6.99% total interest over 30 years on a loan amount of $324,000 would be $450,000. I'm able to, in all fairness, I'm able to tax deduct that. I'm missing that this year, so I wasn't able to exceed my standard deduction, which is like makes me want to cry because I had a lot of tax I had to pay. But regardless, I also want to point out to your attention here that if you guys pay this down to $304,953 within like the first month or year, you guys will save literally over $100,000 because amortization schedules are front loaded. But if you don't want to do that, that's fine. Look at what just putting only $200 extra a month, right? So that's how many Starbucks coffee is $200? Is that 1 week of coffee these days? I mean, the inflation's out of control. I mean, geez, I don't even go to Starbucks anymore. I won't even go there. But anyways, if you only put $200 a month, look at you save $120,000 and you just turned your loan into a 23-year loan, 23 years and 3 months. Only $200. It only takes a little bit to make a large difference. And that's really what I wanted to say there. Let me come back over here real quick. And I wanted to couple points. Charles, where'd you go, man? Couple points I want to make here, you guys, and then I want to get Charles' take on what's going on with mortgage rates and see see how Discord has been sharpening you. I know you've been sharpening me. Hopefully, it's a two-way street, Charles. But a few things I always want you to remember, you guys. First of all, normally when you shop a broker versus a direct lender, you will often get a much better deal using a broker versus direct lender. Now, I compare that to Costco. Charles, if you go to Costco always wins. I can't believe it. So we went to Costco and Costco has information on lenders for mortgages, right? And they were like comparable to the broker. They were off by like $100. So maybe if you guys want to check out Costco, go check out Costco, but definitely do your shopping. And also remember, you guys, it's not necessarily about interest rate. It's about pricing. It's about the cost of the interest rate. Also, in some situations, making minimum down payment, actually in a lot of situations, FHA can be cheaper. So a few things I wanted to cover now. Charles, before we move on to our first video here, what do you think is going on with the interest rates? And when do you think they're going to cut rates and why, brother?
I do think they're going to hold interest rates for a while. The current thing is no one wants to get left holding the bag, essentially. No one wants to be the bad guy, right? Everyone knows the market is frozen, but it's kind of like who wants to commit that party foul that it's over? It's like no one wants to be that guy. And the reality is neither party, politically, whatever you want to say, no one wants to do that. There's a lot of finger pointing. They could get stuff done right now, but they kind of want to use it against each other. So there's a lot of posturing going on. And that's part of the reason why there's no solutions. That's why we still don't have a budget. We still don't have the child tax credit passed. There's a lot of stuff going on right now in the backgrounds. And that's kind of the reason why. In terms of interest rate, the Fed is technically a separate entity. Jerome Powell is appointed. He doesn't really have, he's not beholden to the normal person. And he's also very far disconnected. He's worth 20 to 50 million, depending on the sources. So he's not a person he's one of the guys. If you ask him how much a gallon of milk is, he probably has no idea how much a gallon of milk is, right? So he's disconnected from that part of society. And so they're not really beholden like the politicians are, where they have to commit to anything. Honestly, I actually question why they even work on the Fed. For him, I think they make $250,000 a year. So I always wonder, why would anyone even volunteer to be in this position? Is it kind of just a feather in their cap one day, I was the Fed chair? Because financially, that's a drop in a bucket to him if he's worth that much money. Otherwise, you start thinking more nefariously, is he getting some kind of benefit? He's hooking up his friends. What is he doing when he's in that position, right? So in this case, I'll always go back to it. I think the Fed is just kind of on a sitting pattern. They're waiting for indisputable evidence that inflation is either going up or down before they could act. And that way they can always point hey, we're just following the data. It's not my fault. I just follow the data. And I think that's what they're doing right now. They're just waiting for what the tea leaves kind of shape out, and that way they could pass on the buck more or less to someone else. They don't have to end up holding the bag.
I mean, I like it. I like the breakdown, brother. Do you think that the rates were high enough to combat the inflation, Charles?
I think it is, to the point you already see the mortgage applications at all-time lows. I mean, at this point, the people that are buying are either cash buyers, investors, foreign buyers, or people extremely well qualified, right? So coming back to our mortgage days, back in 2004 to 2007, there's a ton of people that are not really qualified, not really, right? We would give it a magic wand wave and be like, sure, why not? You get a mortgage, and did no due diligence. Now, if anyone's going through the mortgage process right now, and we have a few people going through it on the Discord group, they'll tell you they're asking for your secondborn, your firstborn, pretty much as part of the underwriting process. They are going back there, they're detailing everything. They're like, hey, we need more bank statements. Where did this come from? If you have multiple accounts, they're asking for everything. And it's enough to where unless you're really committed to buy a house, you're just like, throw your hands up in the air. I'm done with this. I don't really want to move or buy a house that much anymore anyways. So now it's getting to the point where it's complete opposite. And so that's where I think the mortgage rates, I think they're high enough where like no one unless they really, really get a good deal or really want it or very in a bad position where they have to buy a house are like making moves. So, and that's the same thing for the sellers too, right? Sellers are kind of the same situation too. I'm like in a really good position. It's annoying to be a landlord or whatever, or maintain this home, but I know I'm priced out in the future if I sell. So I'm going to only make this move unless it makes a lot of sense, a no-brainer type of situation.
And I'll just say it point blank, man. I mean, I was a loan officer during the GFC in 2002 on income verification. The big difference here in loans, people are like, oh, the loans are so much better. Like, what's better? Like, are you just saying that? Or do you know what's better, what's worse? Like, it's the income. You have to verify like through 3 different ways how much money you're making. And that's like the reason for, all of the documentation plus the Patriot Act disclosure, sourcing cash. But ultimately, man, one big thing that we don't have right now, Charles, we don't have unemployment, exploding yet. What were you going to say?
Well, I was going to say also fixed rates, right? We have all these people at fixed rates. Back in the day, people weren't even reading disclosures and so forth. Some people didn't even know what kind of loan they were getting. They were like, oh, 2-year ARM, whatever. How's it keep going up? I was refinanced. And that's kind of where we had that culture of like always refinance later.
Yeah.
Obviously, we proved in 2008 that's not the case, right? So going back to it is people weren't really worried about it. But now we're at such good rates. People are actually very cognizant of the rates. They're like, whoa, my payments go up double if I refinance. So like people are like, okay, this is the last resort. I'm not going to touch my 3% or 4% mortgage unless I absolutely have to. I'm going to take out personal loans. I'll take out HELOCs. I'll do everything I possibly can because I don't want to mess with that beautiful mortgage that's worth a lot of money on its own. If I can sell that, I would. The mortgage loan. But yeah.
Okay. All right, man. Let's go into. Hey, by the way, I appreciate your perspective, man. Are you nervous at all, Charles? Yeah. Why can't we get Mr. Watson on here, man? Why do people got to be so nervous on video? I get it.
I'm not logged into YouTube right now, so I don't see any of the comments. So hopefully I'm not. But if it was, I have thick skin. I don't care. I wouldn't put myself in here unless I honestly didn't give a crap.
Well,
so,
yeah, man. I appreciate. I definitely appreciate you. And back to what you were saying as far, here's the thing, man. What's very interesting. If you track the interest rates went down during the GFC, not up. Now, obviously, some of those adjustable mortgages had additional rate increases because of the way that they were created. But there were some like 12 mats and stuff, option arms and stuff like that track LIBORs and stuff. Dude, those rates went down. They didn't go up. So when you look at it, it's like, I go back to like, if people can't pay their bills, it falls apart. And so people are paying their bills right now. It's going to keep doing. It's going to keep going sideways. Obviously, the quantitative tightening is helping. I want to move on, Charles, to our next video. Our next video is going to basically be regarding Jerome Powell. He spoke on Wednesday. I wasn't able to catch it. I had to go to a 4-hour inspection for a new home, by the way. And what I learned is some of those new home inspections that the builder has to do through the county are actually public records. So I'm going to do a lot more research on that, but I have all kinds of stuff to tell you guys. But I want to go to our first video. This is going to be about, again, Jerome Powell, higher for longer. And I want you guys to listen. You too, Charles. Let me know if maybe you sense that there's something brewing behind the scenes, maybe. That's kind of that's my take on this. But let's hear this right now, man.
But let me get right to Steve Leisman now, because we do have those breaking headlines from Fed Chair Powell. He is speaking at Stanford University. And what is he saying, Steve?
He says if the economy evolves as expected, it will be appropriate to lower rates at some point this year. But the Fed chair, speaking at the Stanford Graduate School of Business, says it will not be appropriate to lower the policy rate without greater confidence inflation is coming down. He cites the Fed policy statement in making that comment. He said the Fed has time to let incoming data guide its decisions. And the policy rate, though, is likely at its peak. That's the good news. Inflation, he says, has come down significantly, but it is still running above the Fed's 2% target. The job of sustainably returning it to target, quote, is not yet done. Then he talks about the recent economic reports on jobs and inflation. They have come in, he says, higher than had been expected, but they do not, quote, materially change the overall picture. So what he's looking for is he sees solid growth in the economy, labor markets rebalancing, getting a little less tight in the labor market, and inflation will be moving, as his forecast, towards that 2% target. But he cautions it is too soon to say whether the recent inflation readings represent more than just a bump on the road toward that 2% target. He has a section there where he talks about risks on both sides of the equation, both the risk of reducing rates too early and reducing them too late. But monetary policy is, quote, well positioned, he says, to confront both risks. The Fed decisions. He has a section in here where he seems to be addressing concern about political bias in Fed decision making. He says all of their decisions and analysis are, quote, free from any personal or political bias. And he goes on to say the Fed needs to avoid mission creep, and specifically in relation to its role in the climate change debate. So I'll leave it there, Scott, and basically say I think that Powell is very much repeating where he's been, although maybe just leaving a little bit more room for the recent inflation reports not to have been a bump here, but he still seems to be on track with this idea. Sees inflation coming down, and it will be at some point appropriate to cut interest rates.
I feel as though now, Steve, there appears to be a real simpatico, if you will, between Chair Powell and the other members of the Fed, in that they're almost saying the same thing in unison now. We're not there yet. We expect to be there. We're going to cut. We're just probably not going to do it on the schedule we originally thought or the markets first thought. We're just all going to get our arms around that idea.
Yeah, I mean, I actually tend to think there are a few interesting differences on the committee right now. And those differences concern how you digest the recent inflation reports. I think some saw them as more of a serious setback than others did. I think Powell is more or less in the camp of seeing it as a bump and believes inflation progress will continue, although perhaps slower. I think others see it more as a cautionary note that says, you know what, maybe I need to back off a little bit, or back sometimes way off where I thought I would be. Bostic this morning, he says don't start thinking about a rate cut till maybe Halloween or Thanksgiving or even Christmas. He's in the fourth quarter on a rate cut.
Yeah, interesting. I guess
one of us was echoing, so I put us both on mute. We're off mute.
Yeah, it was me.
The market doesn't know. I feel like we're doing a better job, man. I really feel like as a community we do a great job. We hold each other accountable. I was way off, man, though. I'll admit it, on my forecasting in 2023, 2022 home run. 2023 we got a lot. We got the new home stuff right. We knocked that out of the park, but we missed the recession, any type of unemployment or foreclosure in 2023. And I ask why, man, and there's just the inflation. There's still just so much deficit spending. But I threw this question up here, Charles, because I want you to first try to answer, try to respond to this. And I don't think it's a troll comment. I don't think, by the way, Stephen, by the way, I appreciate you commenting. I appreciate all of you guys commenting. As long as you're not like trying to hurt people, right? So rates were low in 2020. Well, actually compared to now, for the last 10 years, but rates were low, especially during 2020, 2021, right? Into the beginning of 2022. And Stephen's point was, hey, like if you would have purchased then, you probably would have you'd be in a really good situation right now when you could look at rent, when you look at home prices, things like that. Charles, could you respond to this comment? I'm interested to how you would respond to this.
Well, I definitely agree with Stephen that you should definitely try to purchase when it was low. The caveat, of course, was a lot of people were trying to purchase when it was low, which is why it was a total wild, wild west for people waiving all appraisals, contingencies. People are buying houses online, if ever even visiting the property. So, I mean, it wasn't that easy, obviously. If you could have purchased, for sure. You should definitely, if you owned the house at a time, you should definitely have refinanced, right? But that's where the issue becomes kind of in play. It was people are trying to buy. They're losing to cash buyers as they are today. There was a ton of people flush with cash at the time, but obviously you should have just bought. If you could have bought, if you turned down an offer, and honestly, in hindsight, you go, if I should have just gone up another $5,000 or whatever it was, and you'd probably be better off financially right now. But it wasn't that easy. There were some people that got sidelined unfairly just because of the fact that it was just such a hot market that people were just kind of going crazy and just abandoning all principles. But some people were also saved. But if you didn't bid in certain markets and so forth, a lot of the boom towns, especially, you probably are better off then as well. Or you're neutral, right? You could have done other stuff with the money. You could invest in T-bills or stocks and so forth, and you might be better off, or you might be worse off depending on what you're investing in. But it's kind of hard to play revisionist history here. Hindsight's 2020, of course. So,
yeah, I mean, when I look at this, I think we got to be cautious, and I don't think Stephen was being disrespectful in any way, but people often like are belittling, even bullying. If you're renting, you're looking for a house right now, like, oh, you should have bought, but I personally try to buy. I put in multiple offers in 2021, so I want to remind people, like, hey, during 2021, yes, that I was still helping people in 2021. It started to slow down because I started to see what's happening, and then I got out in 2022. But you guys can't forget the bidding wars, the waiving contingencies. I mean, the amount of war, you literally had to go to war, sacrifice any fundamentals, any type of, wedge, any type of these fundamentals to get a good deal were right out the window. You had to be at the mercy of the seller. So don't forget that in order to get a good deal, almost you had to be a little bit lucky and overbid. So because there wasn't enough inventory, if we look at the active inventory for February, Charles, it was less than 400,000. Yeah, I think it was like 380 or 360. So it was low. So don't forget. Yeah. Some people have $200,000, $300,000 in equity with a 3% mortgage rate. But in order to do that, most people had to turn their back on values, fundamentals, and things of that nature. So don't forget that. So there's just, look at both sides of that coin right there. But yeah, I mean, those people are certainly better off than buyers today. If you purchased obviously prior to 2022, you're in a different world. Would you agree, Charles?
Oh, absolutely. I mean, right now, if you purchased pre-2022, really, right? If you posted anytime it was sub 4 or 5% interest rate, we could run the mortgage calculator and calculate it. But you compare your rent might be more currently to rent the same comparable property as your mortgages. So all those own homeowners, congratulations, you won. Both combination of mixture of luck and skill, maybe both or one or the other, doesn't matter. The whole point is you own the house. And so you're in a much better position. So have some empathy. Of course, everyone wants to be a homeowner. Or almost everyone wants to be a homeowner. Let me just clarify that. Almost everyone wants to be a homeowner. You've got a space. It's a limited finite amount of homes that are available. And so appreciate it. And so just don't rub it. You don't need to rub it in the nose. You already won. All right. So that winning's enough sometimes. You don't need to rub it in.
Yeah. So, I will say though, some of those people that what does suck though, Charles, if any of those people during, I think there's probably a lot, but those people 2020, 2021, 2022, yes, they have the equity, they have the low interest rates, but also if they started spending, getting, new cars with $1,000 payments and they started spending like that, like a lot of people, guess what they also got with homeownership? Skyrocketing property taxes. Mine are up like 50 freaking percent. I just got dropped for a renewal on my insurance. That just skyrocketed like 60%, went up $1,000. So there's pros and cons to everything. If people constantly say this is a new normal, well, if it's the new normal, then we seriously have to consider the dangers of purchasing and the benefits of renting. Fine, let's talk about the new normal, but let's talk about how do we adapt to this and how do we prepare I believe there's a huge storm. I think it's clear as day what's going on behind the scenes. What I don't know though, Charles, is the effects of all of the deficit spending and the continuous money printing and inflation. I have not gone through that in my adult life ever. I try to look at the 70s and 80s to try to get an idea of how inflation affects specifically the housing market. And I look at the consumer today versus during past inflationary cycles. And it just looks real bad, man. It just looks real bad.
It does look bad. There's no doubt that, on current course, if we're the Titanic heading towards a giant iceberg. But at the same time, the only solace I take is, as bad as the U.S. may feel we're doing right now, our economy is honestly resilient. We are still doing better than all our real true competitive countries that are developed. They're all doing worse than us. You can see Europe's falling apart right now. Japan's in a recession already. So if I joke about this, but you don't have to be faster than the bear. You just got to be faster than the guy next to you. In this case, every other country is struggling more than us, right? So it's kind of like very important. Economists normally look at a lot of case studies. We're looking at what's going on in Argentina and other countries that have essentially economy collapsed in recent years. And you kind of look at what they're doing. Obviously, the U.S. is a totally different beast, right? We're like 50x, 100x bigger than Argentina, for instance, right? But you look at it and you kind of use like, okay, what did they do correctly? What measures did they take? Is there anything we can do realistically to try to stop it? But like I said, we're still in a good position. We're on top of the mountain. We have the high ground. We have the reserve currency in the world. We're still doing better than everyone else in terms of inflation. As bad as it may feel, or mad as it might feel day to day, other people, other countries, people are doing way worse. And, so it is what it is. So,
yeah. No, I mean, you're not wrong. I mean, there is a lot of other countries are doing worse, but I'm cautious saying that the economy is strong because I don't consider spending money that we don't have strong. I consider it manipulation because, again, man, like when we take away the deficit spending, there is no GDP growth in 2023. If we take away deficit, so go ahead.
We're a debt-based society. I mean, if everyone really, so it's ironic part, right? If everyone in the U.S. became a really good saver, right? A good example is China's GDP per person, its capita is actually much lower than the U.S., but they have a higher savings rates for us for the last like 20 years. Like, so everything, they make less money than us, but they save. What about net amount, not percentage based? They actually save more. Let's say we save $500 a month there. They save $700, which is insane because that's like half their income. So like when you look at it, we're a debt-based society. We turn off that spigot, so many businesses would collapse. Like it is priming the pump times 1,000 in this country now. Like the minute people stop going out to eat, that restaurant closes. Those people don't have jobs. They can't pay rent. Their landlords suffer. So like it's just the whole house of cards fall. We saw that during COVID.
Yeah.
Like that's
so it's like
spend money because literally like, people going to work for 2 weeks. Completely everyone collapsed. Like we had no money. We can't pay anything. And so now
I get it.
The trickle effect was huge.
But normally it's not government. Normally it's not the government. It's the private sector. So jobs. It's that stuff supporting us. So what happens when you turn the life support off? What happens when you take the needle out of the vein? What happens when you take the training wheels off? We know, Charles, we know. But I understand your point. The world, right? I get it. It's just, man, my God, this is so crazy. Now I want to move on real quick, Charles. And hey, brother, thank you so much. Oh, James, brother, I appreciate the support. And he's got some point. When America does bad, the third world starves. I mean, that's the point. And also, like when they're doing quantitative tightening, like the lower class, don't forget, guys, they get hit first. And that's why, Charles, I respect so many, we got so many great people, but I myself, I get petty sometimes because of how I raised and where I was born. Like when I see the bullying, and you're a wrestler, you understand what I'm saying. And my God, dude, my ribs are finally starting to feel better. Jeez, dude, I couldn't even breathe. I had the hiccups one night. I was having the hiccups with like 2 broken ribs. I don't know if they're broken, but like right here, oh my God, it's brutal. My point is, dude, there's people getting crushed right now. There's people that have lost their jobs. There's people that are in bankruptcy. There's people that are going through the foreclosure process, don't know what to do, short sale process. There's people getting hurt right now, and they got to get hit first, unfortunately, while the rich get richer. And that's what I'm saying is the sad part, about all this. And I hope, Charles, that we can make people strong like you, strong like me, the people on the bottom. And I see that. And that's why I wanted you on here. I wanted people to say that we do have a community in the background. We usually all get along. I worry about you sometimes. I'm not going to use it. I worry about you. I want us all to get along. We could stress test each other, but I think we love each other. I think so, man. I think that's why we're in the Discord, Charles. And man, that means so much to me, brother. I mean, I get so burnt out doing these videos, man, because I didn't go to college for this. I don't know what I'm doing. I learned everything from you, from our Discord community, from YouTube, and this has been such an amazing journey. Which reminds me, as you guys know, in the Discord community, I did list my house for sale. I have no interest. I also put in an offer. So what do you mean? You're trying to sell your house, but you put in an offer? We'll join the Discord community, right? Look past the headlines. Listen to what we're saying. Listen to how we're helping. But anyways, we're going to go on to the real estate portion. I'm going to re-update this timestamp because I was rambling. I'm sorry, Charles.
Oh, it's all good.
You're supposed to text me if I was rambling. All right, but take a look at this. I'm just going to put it over my face. Now, I've been tracking 15 metro areas. Dang it, I don't know how well we can see that, okay? So I've been tracking 15 metro areas just to see what's going on. I'll zoom in. Now, I have 10 concerning markets, and I have 5 markets that I consider like top markets, okay? So the top markets are on the bottom. Concerning markets are on the top. And what I want to point out, you guys, is basically, let me see, where's my pen at? Okay, so this column right here, okay, is from the bubble, from the start of the bubble, January of 2020. Now, as far as the troubled metro areas, I'm tracking Boise, San Francisco, Portland, Atlanta, New Orleans, Austin, Birmingham, Jackson, St. Louis, and Memphis. Okay, now I just wanted to point out, those are the ones I'm tracking because I saw distress, but every one of those except one is still over January 2020, except, this is crazy, Jackson, Mississippi. People, oh, it's Jackson, Mississippi. Well, so it's a housing market. Jackson, Mississippi is down 8.5% pre-COVID. So they've lost all of the bubble, and they've lost even more. And also what's interesting is San Francisco is only up 3.98% from January of 2020. Obviously, New Orleans is close. Birmingham is close. So they're barely above. But let me show you this. This is crazy. Okay, let's go to the next column. The next column is from peak. Okay, Comic Lover would have a mental breakdown right now because he doesn't like talking about peak numbers. He wants us to talk about his numbers, or we're evil people. So anyway, so here's from peak. Every one of those 10 metros is down almost double digits from peak. Okay, minus right here. Okay, which was Atlanta. So again, Boise's down 22% from peak, San Fran 15%, Portland 17, New Orleans 17, Austin 21, Birmingham 29. Jackson is down 58% from peak. So I wonder, what do these homeowners have to show? Right? I wonder what these renters have to show for in Jackson. Maybe the lack of foreclosure. Maybe what they have to show for renting is they don't have a foreclosure on their record. I don't know. But regardless, St. Louis down 17%, Memphis down 12%. But look at this. Look at this month over month. This is the craziest thing because this differs from the top metros. In fact, almost every single distressed metro, Charles, went up month over month. And this is just to February because I don't have median yet for March. I will have this updated. But month over month, almost all the distressed metro areas were up. And they were up month over month, brother. Look at this, significantly. Look at some of these increases. Absolutely astonishing month over month. 19% month over month, 28% month over month, 12% month over month. I mean, this is completely chaotic. Now, when we look at the year over year, okay, now Redfin only says that there's one metro area on the year over year price decline list, which is San Antonio. Okay, they're saying only San Antonio is down year over year, but look at some of these metros, and I should post this in my community, are down year over year. Okay, you see that? 43%, 4.6%. But look at this. This metro is now up 12% because of just their 1 month increase. All I'm trying to say is this data is all over the place. Now, the top markets, look at this, Charles. The top markets that I'm like, okay, these markets are going to go up. 3 of the 5 were down month over month. That's insane. So the top market's going down. Huh?
Sorry, I can't see the city. We can't see the city on the left side.
Oh, okay.
Is there a way to zoom out and we can see it that way?
Yeah, I'm sorry. Yeah. Okay.
Oh, no worries.
Okay.
So here's some long explanation for some of these. That way. Okay.
I'm sorry, brother. I can't take my name tag away. All right, I'll just say, okay, so the first city's Miami. Obviously, I'm tracking Miami. I'm tracking Anaheim. I'm tracking Newark. I can never pronounce that. I'm tracking Wilmington, and I'm tracking Columbus. So the first one's Miami. Okay, so Miami was down month over month, 3%. Anaheim was up 2.8%. However, Newark was down 7.8% month over month. That's a huge drop month over month on a top metro. Wilmington, I've been tracking Wilmington. I drove out there. Wilmington's down month over month, 4.92%. Okay. And then Columbus is up a little over 2%. And year over year, here's our year over year. But this is just something that we have at least to where now we could, track markets, see what's going on. We have top markets, we have bottom markets. And what I'm noticing right now is stuff is still all over the place, Charles. It's still nice to look at the peak and the trough and see the bubble versus how, far out versus year over year. So we have data. I think it's going to be really neat comparing Birmingham to Miami. and things of that nature. Did you want to comment on that?
Right. When the peak data, I'm curious, how long was it in that peak range? Because I think part of the problem was, are you still there?
Yeah, I'm here. I'm here.
Oh, okay, your screen, your image froze. I'm not sure if that's the case. Okay. Anyways, I think part of the problem was it was such a rapid rise in interest rates. It really, that peak was very short. Like, so we're talking about a very small amount of people that actually bought at the peak of the overall recent home buyers. And so that's why it skews the numbers a little bit, in my opinion, is that was a real spike. Everything else was probably more normalized over the rest of 2022. That's my opinion. It's like the last 4 or 5 months, it actually calmed down really, really fast, right? And you see a lot of people that bought 2022 got really good deals, actually.
Yeah. The interesting thing, though, is if we look at the last 100 years of home values, they would also say, oh, well, this peak, it will be short-lived too, right? I mean, so, it sucked. And also the peak was in one of the busiest times of year. So some of the most amount of homes were sold during that year, during the peak. I hear what you're saying. Obviously, it goes down. That's why it's called a peak, right? If it would be called what, a plateau? Was it a plateau when it doesn't go down, right?
It wasn't like a peak for like 3, 4. It was like a table. It's a table, whatever bump, right? Like it's actually flat for a few months, and then it starts tanking, right? But this was okay. Maybe all the deals that were in contract in March or May of that year, like they still had lower interest rates by the time they closed, right? And then so there's things like that, like it kind of dragged on. And then so that's why it kind of skews the numbers. That's why, it depends on the market. It's very viable.
I wonder, yeah. And Charles, it's interesting. I mean, but we do the same thing on the bottom. So we're tracking from from January 2020. So I mean, by that rationale, maybe we should only track like 4 months, right?
We can't look at a 5-year projection anymore. Sometimes it may just be month to month.
I know. I mean, things are just crazy, man. I just, what I like though, Charles, is at least we have the data to look at. There's so many narratives. At least we have okay, we have peak. If you want to look at that, we have trough. We have year over year. We have month over month. We have the good markets. We have the bad markets. All of this to say you got to be careful with you, right? Mm-hmm. And that's why I like Charles too. Charles is very careful. He's very smart. He's very savvy. He's not just going to go out and buy a house. Everyone is calculated, I would say, in our Discord group on how we're doing it. Wanted to give a quick shout out to Jo. Stick your down payment in T-bills. That's what I did. People are like, what do you have to show for rent? Well, I'm making $300 a month on my down payment. That's one thing. But basically what Jo is saying, T-bill and chill, high yield, let the bank pay you the rent for you. I'm currently doing this, and they're paying 100% of it. So Jo's having his rent paid from his T-bills. I don't have that many T-bills. You know what I mean? I wish I had that many T-bills, Charles. I don't have that many T-bills, but it definitely, my rent is reduced about 10% because of T-bills. It's a little more than 10%.
It's a simple game. Yeah, well, it's a simple game, right? If you're getting, right now, inflation's like what, 3% roughly? If you're doing 5%, there's arbitrage right there. You do about 2%. There's a 2% margin right there, right? So you just kind of play with it. If you're doing a stock market, depending on what you're investing, you may be up, depending on if you're really good at picking stocks, you might be up 20-30% this year. So you're seeing that 5%, not that impressive. But you could also be, investing in the wrong stocks and be down 20% right now. So it is one of those things where you just got to play the rate game on everything in your life. Whatever's the highest rates, you pay those down first. Whatever's lower rate, you actually kind of want to sit on them. Still loans, mortgages, whatever it is, car loans. Sometimes the rate's lower than anything else you can get. And so those ones you actually don't prioritize as much as the ones that are very high interest rates. Those ones you pay off first.
All right, let me show, let's move on to this, brother. Good points. Thank you so much, Charles. Let's look at this real quick. One of the things I wanted to point out, this is from April 4th. So this is an article from yesterday. And basically, homeowners are dropping prices at record paces right now. We have a new 5-year high for people dropping prices. So I think we're in a good spot. I still think, again, there's still runaway inflation. There's still a ton of money in the system. But I think that, consumers are starting to, and the demand for these overpriced houses are starting to wane because, again, 5-year record. This is way different than 2021, 2022. When everyone's saying, oh, we should have bought. Well, I tried to, right? I wasn't willing to sacrifice my American values to purchase a house at that time, but the prices are being cut. So I'm saying where we're at as far as the restriction is good. If anything, I think that we could have higher interest rates, make it even more restricting so that we can get inventory back. And again, when I say inventory back, when they drop rates significantly, people will flood back in to sell their house. Obviously, there will also be demand flood back in if rates go down, which which is why I'm saying rates going down has to correspond with unemployment. If it doesn't correspond with unemployment, I don't think a lot is going to happen in our favor. But then I go back to, why would they continue to stimulate the economy when they've been stimulating the economy for 4 years? I don't know, because they're drug addicts. Who knows? But anyways, guys, it is going down. One more thing that I did want to point out is this settlement. A lot of people, this is kind of one under the radar. This is Open Door. And by the way, I shopped Open Door for the home I have listed that I have no interest. And they were about, would you say, Charles, like they were close to market. They were like 5% off market. Yeah. So they got really close. But take a look at this. This came out yesterday as well. Real estate settlement. Who is eligible for a refund of $1,024? This is not the NAR settlement. A lot of people don't realize that. If anyone that is watching this used Open Door to sell their house, you are eligible for $1,024 because they have lost that lawsuit. The Federal Trade Commission is sending refunds to more than 50,000 home sellers who used an online real estate company. The refunds are part of an agreement with Open Door. So interesting, right? Very interesting. A lot going on. A lot of danger still out there is the point I'm trying to make. And, as a result of that, maybe we should continue to be, just continue to be, where's my man, Charles? Continue to be cautious, man. I mean, it's just such a, it's, what's hard, Charles? Being in this chair, trying to talk with such specificity that it makes sense to every person, because your goal is different than my goal, your market's different than my market. So the specificity that goes into like talking broadly is very difficult. And you've heard me on Discord. I consider the Redfin data, like when we go into Redfin and we track like local metros, like I just showed you, like if we go into like Kingwood and we look at only Redfin data, that's still macro. It's still macro data. Real estate's so hyper local. You got to go subdivision. If it has a subdivision, it's so localized, you guys. Understand, everything is macro except comps in the place you want to buy. That's the data that we need. And that's why I'm always like, dude, we need to get the public access to MLS. I will train you guys how to be just the meanest buyers. I'll teach you how to be so mean and use the data. But I can't do that if you don't have what's needed to grow and to learn, which is comparable data. So it's a little frustrating. We're going to move on. Charles, go ahead. We're going to move on to the next video unless you wanted to add something.
No, that you got the nail on the head. You got to become a master. If you're a buyer, you definitely should become a master of your local market. The agent should be doing a lot of this for you. That's part of the reason why they're there. But you should definitely, you're the one responsible for that 15, 30-year note. So you should do your homework. And so you want to know what's going on in the local market. Is there some cool new developments that no one else knows about? It gives you the edge, right? Are they building a hospital, or our college campus is going to buy up a bunch of houses near you and so forth? Like there's things that are external that you can use to kind of get a leg up on everyone else. And that's kind of how I buy real estate. I go in there in the weeds and try to find those gems, because that's where the margins are made.
Yeah, I mean, we talk about wedge all the time. So we're going to listen to a video where they're going to, I think it's important, again, to hear all narratives. Okay. I don't want to keep us in an echo chamber. And I also want to be balanced today. I know I've been a little bit spicy recently, but the morning videos is more, again, if consumers aren't being empowered, I quit. If more people than not are not becoming stronger by watching my videos, I'm out of here. I'm not going to do it. I can't do it. I really feel rewarded, man, by the comments I'm seeing, by the growth, by the Discord. But the next video is going to be a bull on how the housing market is doing so well and why the housing market is so resilient. Now, before we watch this video, I want to remind y'all that mortgage purchase application is down 15%, worse than the GFC, and sales and transactions are the lowest it's been since the lowest point of the GFC. And if we go back even further, since the 1990s, there was a period of 2010 where it was actually slightly lower. But in other words, you guys, if the real estate market was doing so well, inventory wouldn't be going up and sales crashing. Do you see my point here? Right? I mean, come on, guys. I guess it's just whatever side you're going on. So that's the video. Let me know if you guys enjoy. Let me know the audio is okay.
Taking things in sort of year to date as a whole.
I got to mute us.
Yeah, I think it's better to take things in year to date as a whole. I mean, month to month, things are going to change. And I think the Fed message will hopefully help to mitigate some of the volatility that we've seen in the housing market. And look, there's a lot of pent-up demand. We see that mortgage rates are now starting to come down. And I think hopefully over the summer, the Fed will cut the Fed fund rate, which will maybe help to inspire rates to come down even further. But the housing market has done incredibly well considering all of the headwinds with tight inventory, rates going up, and the issue of the economy, which has been the biggest discussion of all.
Talk to me about mortgage rates just a little bit more. You said they've started to come down. They came down 4 to 6 weeks ago, ticking back up again of late?
Yeah, but now they're the 30-year is hovering around 6.3%, 6.4%. And I think economists are saying that that's probably the likely place that it will be. Maybe it'll get down to in the high fives if we get lucky. But I think this is where the consumer has now acknowledge the fact that this is where mortgage rates are going to be. They're still historically very low. And this is inspiring sellers to start to put their homes on the market. We desperately need more inventory. That's been the challenge. That's these rates have held people back from listing their homes, and it has also held people back from buying homes because they wanted to see what would happen with mortgage rates.
Where is the market hottest, both regionally and within price brackets?
I mean, look, it really depends. I think you hear the melodies of New York City in the background. I think one of the hottest markets in the United States right now, it's Palm Beach. Miami is also a really busy market, but Palm Beach remains a market where people want to be. Companies have moved, people are investing, and there's just not enough inventory. So that seems to be a great place where people want to go. The challenge is obviously inventory. And New York City, we're a great place because we do have ample inventory. And so we're seeing the market pick up here, which has been a good thing. But it really depends on people's circumstances. Remember, the market is here to serve you, right? And so people have to decide where they want to be, where is the best place for them to call home, and make the decision according to that.
And talk to me about how important the sort of confidence factor is. Stock market's doing well. Obviously, there's at least talk of rate cuts. Is that enough to trigger people to start listing those homes, start looking to upgrade, even if the mortgage rate hasn't come down yet?
Yeah, I think it's enough to get some momentum going. I do not think things will be dramatic. You're not going to see this huge shift of everyone putting their homes on the market. As you know, change is incremental. It takes time. But people, by virtue of life cycle, have to sell sometimes because they get a new job, because they're moving to a new neighborhood. Their family is growing. So I think that's going to happen. And I think the fact that people are acknowledging that the economy is in a stable place, Wall Street is very happy right now. And I think that people are feeling a little bit more optimistic than they were. But there are some headwinds. It is an election year, and that always creates some uncertainty. So I think we have to be patient. Patience is important in this environment. And the home.
Did we cut off?
Okay. I got our guy was muted or mic. I was going to say, do you think patience is important in this market?
Absolutely. You should 100%. It's always important, honestly, but it's even more important now, just because the fact that if we already missed out on that golden rate opportunity. So at this point, it's like this boat is exactly the same as the next boat. So might as well just wait for the next one. So you go ahead and find take your time and find a good deal.
So I wanted to throw this up here real quick. I think this is good because it brought me to something I wanted to remind you guys of. In your opinion, what role will real estate agents have in the transaction 5 years from now? The reason I brought this up is I wanted to talk again about the proposed. It's not a settlement, by the way. It has been settled, but it's the proposed settlement. I thought about this more, man, and the more and more I think about the new rule proposals, I think it's an absolute joke. I think it's absolute fraud. I don't think that they're going to change much because when we look at it, all they're doing is saying we're just not going to list the commission on MLS. That's it. And now this is the part. It's like, oh my God! Now they're forcing buyers to. They want to force buyers to sign a buyer's agreement. And so when I start thinking about that, I'm like, that would be a huge win. That would actually be a win for the National Association of Realtors. I intentionally, even though I recently got back in, I intentionally do not sign buyer's rep agreements because it binds the customer to the agent, which means I can't just walk away from an agent I don't like, right? And that's my issue with that form, right? You should be able to walk and use any agent that you want as a consumer. I understand agents have to drive around and all these other things, but this is a huge transaction. And so like more and more I think about it, I think it's fraud, man. I don't think anything about that settlement is really going to help home buyers. I think that home sellers are waking up to like, yeah, maybe I should be aggressive when I negotiate my commission. You really can't negotiate without the aggressive part. I think it's fraud, man. And to answer this question, living in Omaha, it depends how good the agent is. I think good agents will stick around. I think bad agents will not stick around. I think as an agent in real estate, it's just going to get harder and harder for you to support yourself as an agent, especially if they make a requirement to reduce commission. I get a lot of hate, Charles, but I think there should be a cap. I think they should. I'm going to get so much hate on that, but that's what they did to loan officers.
I agree. I mean, there should be caps, or I think the model needs to change, right? The part of the problem is they essentially had a monopoly, so they can set the market rate. So you're going to be shopping for a listing agent. You're paying the same commission or near the same commission either way. I mean, the 1% listing broker has been around for a while, but that's kind of, bare bones service. I think the way I would prefer anyways, and obviously this is without knowing how the business model might actually work out, would be right now the biggest barrier for selling for a lot of homeowners, besides the rate lock effect that we talked about, is the cost of selling. It's like 6 to 10% to sell your home. It's not a liquid asset. You can't just post it and sell it and get your cash in a day. It's going to take 30 days, 2 months, depending on circumstances. To take quite a while. And on top of it, you're going to lose, 5 to 10% of the home equity just from closing. So it goes both ways, right? So I would think in the future, people hopefully become a lot more self-engaged, self-responsible in terms of home buying, and the agent should just help guide them through a lot of the transactional paperwork, because we don't need everyone to become a real estate agent or expert in how to write these contracts. That's just not inefficient for an entire system, period. But everyone could kind of use it. Okay, this would be a flat rate. People already do this currently with like real estate attorneys. They'll have them help them draw up contracts. So yeah, we just do a couple $1,000s. Doesn't matter. Of course, a lot of the homeowners, we're talking about those ultra luxury, $50 million Jeff Bezos type properties. Yeah, the agent should obviously those are not the same as a $200,000, $300,000 property. So there's a little bit give and take, but it all should be negotiable. So, I think the agents going forward are probably just going to be more transaction. You got to be more volume based versus just like, hey, we're going to take a percentage. I do a crappy job, doesn't matter. I got you to sign a contract. So you want to buy a place, you're locked into me for 12 months, whatever it is.
I mean, but it's bullshit. I almost said this. It's BS, man. It's BS because now, as a buyer's agent, I don't have to like tiptoe like, oh, will you please sign this? Like, hey, it's the law. You better sign this, clip your wings. You better sign this, clip your wings, because now you're bound to me. They want to make that a law. So they're deciding like, go ahead.
I haven't reviewed it yet. Is there like a 3-day cooling off period? Like,
it's all proposal right now. We don't have any.
Yeah.
I haven't seen anything. I haven't seen anything as far as what type of language will change on that. But maybe I'm old fashioned, man. I don't agree with the binding someone to use an agent, especially. I don't think that's consumer protection. But so I think it's BS. I think the settlement is total BS. It makes sense because of the biggest lobbyist organization in America, and they're acting like, oh, they're going to get crippled. It's the change of the 6%. No, it's not. What is there in the law that says that they can no longer charge 6%? There is nothing in the proposal that says that. And so the industry will figure out a way to continue the 6%. It's going to take a lot of sellers being mean. And then this whole time, the buyers are the ones that are suffering. New home builders are the ones that are winning. And sellers are like, okay, maybe I win a little bit, but they're going to pocket that money anyways. So, I think it's weak, man. But moving on to liquidity and recession, here's the 10 and the 2. Obviously, the inversion from the start of the inversion was right here. We went uninverted and sustained inversion. We sustained inversion July 1st, right around July 1st, but we first started inversion, or we first inverted April Fool's Day. That's crazy, of 2022. So we have been 2 years inverted since the original inversion. That's nearing record levels, which is very, very interesting. Now, I also wanted to point out the reverse repo market, which is Danielle DiMartino's mentioned that it's kind of like the suspension system, the economy, because of the amount of liquidity that's on the sidelines. This is sideline liquidity sitting at $438 billion. That had ballooned up, Charles, $150 billion from 413 to about 594. So actually even more than 150 in just 2 weeks. I thought that was interesting. I didn't know if it was taxes. I didn't know exactly why. Now that has been recently plummeting downward. Keep your eyes on that. This is one of the lifelines to the economy. Now, this is something I'm going to start looking at more and more. This is real M2 growth. Okay, so M2 is how much money is circulating the economy, right, or the U.S. So real means adjusted for inflation. So real always means adjusted for inflation. Remember that. And I wanted to point out, guys, even with the overwhelming amount of deficit spending, which is right here, 828 just from February. I can't wait for March to come out. Because I really want to see how much more they have spent. But the deficits, I mean, there's no way to compare this to the GFC because we really started doing deficit spending when we were already in recession. So leading into the recession, there wasn't this huge amount of inflation. So it's, again, Charles, it's hard for me to say that, yeah, they're battling inflation, which is money, okay, when I see this. Because they have started this prior to recession. Come on, guys. They didn't do that during the GFC. GFC, look, there's like no deficit. In 2007, there was only 0.16 trillion. They did deficit because, oh my God, we got to stimulate. And then they just got hooked. Oh my God, my cat's trying to get in. Oh my God, my son. Hey, what? Hi, buddy. Huh? I don't know where mommy is. Can you go, please? I love you. Sorry about that. That's my little boy right there.
You see the trend, right? They did start reducing it after GFC. They started reducing it. It was going the right direction up till 2015. Then we had big tax cuts in 2016, 2017. And obviously COVID, pandemic, BP and all that stuff blew it all off the roof. I mean, that is what, triple the deficit in 1 year? So yeah, looks about triple. So yeah. I mean, that just taints all the data, right? Every data going forward is like, this is a new game. Like the rules completely changed. So
the rules completely, and that's what's been such a hard read. This is something that I was blindsided by. I did not think that. I don't want to use crazy words, but I'm just going to move on to the next part of this. Now, take a look at the health of the consumer, okay? Because again, we're the ones that are paying this. Now, this is just recently updated. The savings rate plummeted again to 3.6. The savings rate right now is 3.6% as far as households. I want to, again, because and I think there is points here that I understand and I would lean towards, but the consumer during the 70s and 80s was so much different. During recessions, they were able to save 11 to 12% of their total income. You see this here. Same thing in this recession, up to 14. Look, they're saving out 14%. The 1980s recession, 12%. You guys, we're saving 1/4 or 1/3 of the way that consumers were saving during the 70s and 80s. I just don't think the consumer is strong. And then when we look at the real, remember, real is adjusted for inflation. When we look at real median household income has not been going up with inflation, which means we ain't getting the money. We're just paying the bill, guys. I mean, we got those little, $5,000 checks sent to our checking account. Wow, that was great.
I would bet a hefty amount that savings amount is skewed. It's probably just a small percentage of people that are actually positive cash flow right now. Most people are probably negative, right? I mean, and those are the same people that would benefit from housing crash, by the way. They're the first ones to buy a house that people have.
You know what? So you brought me to, you know what? You brought up a good point, man. Like, the way I look at it is you got to be able to afford to qualify right now, because when we go into recession, it's possible that it's going to be harder to qualify for stuff. There's probably going to be lending restrictions. There's going to be turmoil in the job market. Don't expect things to get to become easier to buy from a credit standpoint, maybe from a price and affordability standpoint. But in other words, what I'm saying, Charles, you got to qualify right now. You have to, if you don't qualify right now and you're hoping to qualify during a recession, it's harder to. That's my point. Now, here's another thing for consumers: credit card debt. I mean, credit card debt has absolutely exploded. We are, well past 1 trillion, sitting at 1.05 trillion with a T. So, there's some turmoil here, man. We're going to go into one more video. And then what I'm going to do, guys, is I was going to do the market analysis on a subdivision, but I'm going to save that till Tuesday just because we're running out of time. And so let's just listen to this last video. This is basically being patient with the Fed. I'm going to mute us, and then we'll finish this out.
Do have these headlines now from the Richmond Fed president, Tom Barkin. Let's get right to Steve Leisman, who has those for us. Steve.
Yeah, and really adding to the conversation you guys have been having, Barkin saying it's smart for the Fed to take our time before beginning the process. Remember that word, the process of toggling rates down. So he's a guy who thinks they ought to do cut rates but not necessarily right away. He's optimistic that keeping rates somewhat restrictive can bring inflation back towards the target. A couple bullet points here. He's looking for inflation to decline, and he wants it to be sustained, and he wants it to broaden to more goods. We've heard that from a bunch of Fed folks recently, the idea of broadening the inflation decline. The full impact of higher rates, he believes, is yet to come, especially showing up in balance sheets of corporations and higher interest payments. The economy, he believes, is less vulnerable to a slowdown because companies have spent a lot of time preparing for one that didn't happen. A couple other points. He says the risk of continued shelter and service inflation is something he's watching carefully because goods prices, which have been negative, have started to normalize and be more towards the zero line. He believes the Fed has the firepower to respond to a slowing economy and knows how to react to the overheating economy. Because Josh and I like the same music, think about the markets the same way. I actually prepared a cheat sheet for just what Josh was talking about. We know, for example, 17 of 19 officials have forecast at least one cut this year, with the median at 3. But here's what everybody is pretty much saying along the same lines, Scott. Cuts are forecast, not promised. They're using phrases like it'll be likely appropriate sometime this year to cut. They're absolutely data dependent, using phrases like if the economy evolves as expected. And they're in no rush to cut, saying policy is well positioned now to go either way. And we have time. I'll leave it right there. But that's really what you just heard Barkin use that phrase, essentially. We have time. That's where everybody is. And the whatever Josh was calling it, the cut, no cut regime that we're living under right now.
That sounds this. So these remarks sound more cut off than they sound cut on. So nobody's saying no cuts, but this is another like, hey, it's not June. Just to me.
Josh, can you nuance your phraseology? I know it sounds really good the way you said it, but it's not quite cut off. It's cut delay or cut later, or everybody's still in the cut
Same
camp.
thing. Steve, we're talking about June. So it's cut on or cut off for June.
Okay, so that explains the volatility that we've seen, by the way, over time. All of this is being expressed, guys, in the June probabilities. I've had it as low as 53%. It's now, I don't know what, after Barkin, but it had been about 62, 63% this morning. That is essentially where the doubt and the concern and then the confidence in the cuts is being expressed in June.
You want to just remind us real quick as we wait for Goolsbee in 30 minutes time, the Chicago Fed president, non-voter, by the way, who is going to have his own remarks, what we could expect from him later on in this same hour?
You know, Scott, I keep waiting for somebody to step out of the fold and say something dramatic. I am not hearing it. I am, I guess, impressed and maybe a little bit confounded by how everybody has been in the same camp here. You notice that those 3 tiles I put up, almost everybody expresses some version of those 3 things. What's a dove these days? Maybe one who's a little more confident than the other person that inflation will eventually come down. What was a dove before? Somebody who says, you know what, we got to cut rates right now because we're going to have a big problem if we don't. There's almost nobody in that camp, Scott. And it's not Democrats or Republicans. It's not Trump appointees or Biden appointees to the Fed. They all seem to be pretty much in the same place. What the other thing we don't hear, Scott, is this notion of, we have to change the metric or the target. You know, Bostic, I don't know when he became as hawkish as he is, but he's probably the most vocal hawk on the committee right now. I think others have similar ideas. But remember, yesterday we talked to him, 1 cut, 4th quarter. So chill with your cut on, cut off, Josh, until, I don't know, Halloween now.
You know, one of the issues, too, Steve, is that throughout history, the Fed isn't exactly preemptive or proactive. They're reactive. So even those who may suggest, well, we don't want to eventually have a problem if we leave rates too high for too long, they never seem to actually see the problem until the problem is here, and then they're forced to react.
And then they get it wrong. Look, Scott, one of the amusing things about reading the Fed these days is how surprised they seem to be that they're getting it right. If you read Barkin today, he's like, look, we know this always ends badly. He actually says that in the speech. He goes, and I was just looking at the frequency of higher inflation, higher, Fed hikes rates, and then, it comes down and you have this spike in unemployment and recession. It happens every time. It has not happened this time. It has not happened thus far. The Fed does not have a wonderful record of being able to thread that needle between bringing down inflation and not causing a recession. They're surprised they're getting it right. I think the market is surprised they've gotten it right. If you look at what all the forecasts were last year for the recession that never happened. And again, Scott, what's fascinating,
I mean, is the market really getting it right, Charles? I mean, it's interesting. He says even what's going on is surprising the Fed. But I mean, why? I don't know, man. I mean, to me, I'm just like, why are you surprised? You're printing money still. You have an Inflation Reduction Act. I mean, my God, man. So I just wanted to say, I wanted to bring up a couple of things, Charles, and I want to give you the last words as a member of our community that I definitely appreciate. Wanted to give a shout out though to Chi-Town Real Estate. Love chatting with everyone. I have been trying to build my own channel. Do not be afraid to tell me how bad my videos are. That's funny. You guys go to his channel, check him out. Give him your honest opinion. Let him know if he's doing a good job. Let him know if he's doing a bad job. The content creation game, it could be a little bit difficult. So Charles, I mean, brother, I wish you luck, man, with your real estate career. Thank you for supporting us. But the bigger thing, man, is just thank you for being part of our community and being cautious. We need, the thing is, if we had more realtors like me that are saying, don't buy, slow down, walk away, don't get emotional. Okay, this is a trap. Don't walk in here. I really don't think that we would be in such a bad situation. I definitely think the industry is partially to blame. Yes, it starts with the Fed, low interest rates, consumer spending habits, all of those things, but there's no one that will ever convince me that realtors and that whole fear of missing out and the over-optimism did not help prices explode. No one will convince me that. And so we need more. Quite frankly, I don't follow anyone on TikTok, and I who do I follow that's a real? I would say you're probably one of the only people I'm following that's a realtor. Maybe Todd Sachs. I don't know if Michael's still. I don't follow a lot of realtors because it's just the same cheerleading over and over again, and it just drives me crazy. And I don't want to be a mean person. Last thing here is hopium is a heck of a drug. So is fear. Pick your poison. What is it? What do you want? You want fear? You want hope? Fear of missing out, hope. This is such a dangerous thing to say. Hopium is a hell of a drug. When we look at what is hope, to me, what hope is hard work and sacrificing, using data, not your emotion. And I think that so many people get what we're doing wrong, Charles, which is what we're doing is we're not trying to get stuck in any narrative. We're trying to understand how real estate works. And if first of all, I'm saying we need to wait. Overall, we should be waiting. But if we can't wait, or if we do find a fantastic deal in the meantime, just know what that is, right? Mm-hmm. Don't use the feeling like, oh my God, they cut the listing price $50,000. Let's go get it. How do you know that's a good deal? How do you know that's right? That's my thing. And then, they raised their price $20,000. How do you know that's a bad deal? You cannot know. There's no way of knowing without subdivision analysis. And so if you guys are going out in the weekend looking at houses, please look at the comps and do a subdivision analysis. Don't use your emotion. Charles, I'm going to get us out of here, brother. I want to give you the last words.
No, I think it is. If you're in the current market, don't get caught up in the hype. As Travis says, go to as many open houses as possible, especially given the current buyer agreement shakedown that seems to be going on. Keep your options open, but get a really good, put your finger on the pulse of your local market. You're the one who has to live with it. So no one else should be able to convince you. If I could talk you out of buying a house or selling a house in 5 minutes, you shouldn't be buying. You shouldn't be in the game because you're obviously not very strong on where you're sitting right now. You should probably figure out what you want first before you actually really go out there. I would just go ahead, as Travis said, just optimize everything, go back, cut down on some of your bills, put yourself in the best position to succeed, and really, really, really take your time. If you can find a house that's a good deal and avoid bidding wars and stuff, go for it. But if, again, remember, you already missed out on the easy period. Right now, you're gonna have to do some work. Do some legwork to figure out a good deal. And when you find that, you pull the trigger then. So.
All right, Charles. Hey, and if you guys want to talk to Charles more, join our Discord. If you want to talk to me more, join the Discord. We can't always answer everyone's question. And I threw up that comment like, I know I'm emotional, all right? I'm trying not to be. I'm trying to, I started this, Charles. It's like, I'm not going to be spicy. I'm going to try to be balanced, give you guys just the data. I find it so difficult. Again, no one's taught me how to do this. I feel like YouTube is a platform where I could just be real. I don't have to be perfect. I don't have, and I know I've been going through my cringe stages, and thank you for helping me grow, Charles. I just don't know what I'm doing all the time, but I do know that I love people, and I do know that I want people to win, and you can't take that away from me ever. So other than that, man, I'll see you later.
Well, that's why we follow you, Travis. It's because you are authentic.
What?
We believe that you don't really have a hidden agenda like everyone else in the real estate game. So that's why.
Well, you're wrong. I do have a hidden agenda. 100%. You want to know what it is?
Sure.
I'm trying to get you right between the eyes, Charles. Don't do a double leg takedown on me though. I'm trying to get you right between the eyes, and I'm trying to breathe in empowerment. I'm trying to say this is how pricing works. This is how comp data works. I have a hidden agenda. It's called making you stronger. Making you stronger. Now I got to do the headlines.
Okay.
And I, you know what? In all fairness, I hate doing the headlines. People are like, oh, you did your clickbait. It's like, dude, that's just how it works. Like, I hate it. But like in my videos, you're gonna get data. You're gonna have links to data, and I'm gonna try to be balanced. But I just feel spicy, man. Big shout out to Steve, real quick. Last thing. Johnny's throwing up the Discord as well. Travis, we are visiting Houston and looking at new homes this weekend for a purchase next year. PM me your info so I could be your buyer's agent. Okay, so next year. So Steve, do me a favor, brother. I keep my contact information in my descriptions. I never give it in comment section. There's way too many fraud scam bots out there. If ever you need to get a hold of me, please go to my description. I will warn you, although I barely got back into real estate. I am barely getting back into real estate. And in fact, Steve, I'll be honest with you. I will not be taking on any clients that do not listen to the caution that I'm explaining. If people don't let me do my job, I'm not going to represent them. And my job is to get people a great deal. My job is to wake people up. Don't get emotional. Let me use, and also you want to know something else, Charles, that I'm doing that no one else is doing? Oh, if my people hear this, I'm going to get phone calls. I'm waiving my commission, man. I'm waiving my commission so that we reduce purchase price. That's what I'm doing. So, I mean, people are like, wow, but I'm like, you guys, the commission was $18,000. I just drove you here. What do you mean, wow? I still make 10,000. What do you mean, wow? Like, that's the problem with the industry. All right, I'm going to get some hate for sure. I'm going to get some hate for that. So big shout out. Thank you for that. Email me. Okay, Steve. Now, other than that, Charles, you are the man. And I appreciate your confidence. It's because of your wrestling career. I know it. If you weren't a wrestler, you wouldn't be on right now.
Yeah, it's a lonely place. It's a lonely place. You get used to it.
Oh, dude, I love you, bro. Hey, thank you again for all the help. Join the Discord community. If you guys are out there investing in real estate, obviously we wish you luck and we hope you win. And also, I'll see you guys on Tuesday morning. See you guys Tuesday.